Meta just reported one of the strongest revenue quarters in its history, yet investors focused on a very different number. Revenue rose 28% to $60.8 billion. Advertising remained powerful. Billions of people continued using Facebook, Instagram, WhatsApp, and Messenger. But Meta's quarterly free cash flow fell 91% to just $784 million, its lowest level since the company was facing intense criticism over its metaverse spending several years ago. At the same time, Meta raised the lower end of its 2026 capital expenditure forecast and now expects to spend between $130 billion and $145 billion this year. That creates a remarkable contradiction. Meta's core business is growing quickly, but nearly all the cash generated after operating expenses is being absorbed by data centers, servers, networking equipment, and artificial intelligence infrastructure. So why is Mark Zuckerberg repeating a strategy that once damaged investor confidence? What exactly is Meta building? And how can a company justify spending up to $145 billion when the direct revenue from its consumer AI products is still difficult to measure? The answer begins with Meta's advertising machine. Meta does not need to sell an AI subscription to every user in order to make money from artificial intelligence. Its most valuable AI applications are already hidden inside the systems that choose which advertisements people see, which posts appear in their feeds, and which videos keep them watching. Every improvement in recommendation quality can increase the amount of time users spend inside Meta's apps. Every improvement in advertising prediction can help a business find a customer more efficiently. If advertisers receive better results, they may spend more money. This is why Meta's revenue can grow rapidly even before its public-facing AI assistant becomes a major standalone business. Meta's advertising revenue grew strongly during the quarter, helping total revenue reach $60.8 billion. But costs and expenses increased even faster, rising 55% to $42 billion. Operating income fell 8%, and the operating margin dropped from 43% a year earlier to 31%. The advertising engine is producing more fuel. The AI infrastructure program is burning it almost as quickly. To understand why, imagine that Meta wants to improve the recommendation system behind Instagram Reels. The company must train models using enormous quantities of video, images, audio, text, and user behavior. Training requires large clusters of advanced processors. After the model is trained, Meta must run it every time a user opens the app. That second part is called inference. One training project may be extremely expensive, but inference happens billions of times. A small increase in computing cost for each recommendation becomes enormous when multiplied across Meta's global user base. Now add Meta AI, automated advertising tools, image generation, smart glasses, business assistants, content moderation, translation, and future personal AI agents. Each product competes for the same scarce computing infrastructure. Meta is therefore not building one chatbot. It is rebuilding the technical foundation beneath almost every major product it owns. That explains the size of the investment. Capital expenditure reached $31.1 billion in the latest quarter alone. For the full year, Meta expects between $130 billion and $145 billion, more than double its spending from only a year earlier. But there is an important difference between this strategy and the metaverse gamble. Reality Labs attempted to create a future market that did not yet exist at mass scale. Meta spent heavily on virtual reality hardware and immersive platforms while consumer demand remained limited. The division has accumulated more than $80 billion in operating losses. AI infrastructure is different because Meta can use it inside businesses that already generate hundreds of billions of dollars. If a better model increases advertising conversion rates by even a small percentage, the financial effect could be enormous. If AI helps advertisers generate images, videos, and campaign variations automatically, more small businesses may be able to advertise. If recommendation systems keep users engaged longer, Meta creates more opportunities to display ads. The investment is still risky, but it is connected to an existing cash machine. This is the argument supporting Zuckerberg's strategy. The problem is timing. Meta must purchase the chips, construct the facilities, secure electricity, and hire technical talent before the full revenue appears. Data centers take years to plan and build. Advanced processors can become outdated quickly. Electricity and cooling costs continue even when the machines are not fully utilized. In the latest quarter, operating cash flow actually increased to nearly $32 billion. But after Meta spent more than $31 billion on capital investment, only $784 million remained as free cash flow. That is the central tension. The company is not running out of money. Its operations remain enormously profitable. But the amount left for buybacks, dividends, acquisitions, debt reduction, or financial protection has almost disappeared. A business can tolerate this temporarily if the investment produces higher future profit. It becomes dangerous if the spending becomes permanent while returns remain uncertain. Meta is also making the bet at the same time as every other technology giant. Microsoft, Amazon, Alphabet, Oracle, and others are expanding AI infrastructure aggressively. Reuters analysis found that increased capital investment by major cloud companies may outpace the growth in their operating cash flow through 2027. The group could invest about $1.57 for every additional dollar of operating cash generated. That creates a potential industry-wide problem. If all the largest companies build capacity based on extremely optimistic demand forecasts, the market could eventually have too many data centers. Prices for AI computing could fall. New, more efficient models could require less processing power. Custom chips could reduce the need for the most expensive hardware. Meta would still own the infrastructure, but the economic return could be lower than expected. There is also a strategic question about what Meta ultimately wants to sell. Microsoft sells cloud computing and workplace software. Amazon sells cloud infrastructure. Google sells cloud services, advertising, and enterprise AI tools. Meta's main business remains advertising. That means Meta may spend more than $100 billion on infrastructure without charging users directly for most AI interactions. The investment must therefore create value indirectly. A personal AI agent could increase engagement. A business assistant could attract more companies to WhatsApp. Generative tools could make advertising easier. Smart glasses could create a new computing platform. Meta has also discussed paid AI subscriptions and selling excess computing capacity, but those businesses are not yet large enough to explain the entire investment. The company is effectively placing several bets on the same infrastructure. If one business succeeds, the data centers support it. If several succeed, Meta gains enormous operating leverage. If none produces meaningful revenue, the facilities become an extremely expensive monument to overconfidence. This is why Meta's strategy looks both intelligent and dangerous. The company has one advantage that many AI startups do not: distribution. Meta can place a new AI feature in front of billions of users almost instantly. It can integrate AI into Instagram, Facebook, WhatsApp, Messenger, and its advertising systems without needing to acquire customers one at a time. A startup may build a better model but struggle to convince people to use it. Meta can make AI unavoidable inside products people already open every day. Distribution also gives Meta data. The company can observe how people interact with recommendations, businesses, creators, messages, videos, and advertisements. That data can help improve models and personalize services. But scale also magnifies mistakes. A poor recommendation system can reduce engagement across billions of accounts. An AI-generated advertising tool can create misleading or low-quality content at enormous volume. Privacy, copyright, youth safety, and regulatory risks all become more serious when AI is inserted into every product. Meta's latest quarter included $2.4 billion in legal charges, while the company continues facing lawsuits and regulatory pressure over the effects of social media on younger users. So Meta is not making its AI bet in a stable environment. It is investing at historic levels while legal costs rise, margins shrink, employees are being reduced, and policymakers are questioning the company's existing business model. Meta cut roughly 8,000 jobs in 2026 as part of restructuring connected to its AI push. At the same time, Zuckerberg has argued that AI infrastructure is creating employment in construction, energy, and supporting industries. This reveals another part of the strategy. Meta is shifting spending away from some traditional employees and toward physical and technical capital. Instead of hiring people to perform every task, it is buying infrastructure that may allow fewer employees to operate larger systems. That could improve long-term productivity. It could also make the company more capital-intensive and less flexible. Software companies were once attractive because they could grow without constantly building expensive physical assets. Meta's AI strategy makes the company look more like an industrial utility. It needs land, power contracts, cooling systems, chips, construction partners, and enormous financing commitments. The economics of the business are changing. Meta may still earn money from digital advertisements, but producing those advertisements and recommendations increasingly depends on physical infrastructure costing tens of billions of dollars. This is the hidden transformation behind the quarterly numbers. Meta is moving from an asset-light internet platform toward one of the largest infrastructure builders in the world. The bet may work because its advertising business is already proving that AI can improve revenue. Total revenue grew 28%, even while the company invested heavily. That is very different from a company spending billions without a profitable core. But the latest quarter also shows the limit. Revenue growth alone is not enough. Investors eventually need to see free cash flow recover, margins stabilize, and new AI products produce returns large enough to justify the construction program. Meta has reached the point where spending more is no longer a convincing strategy by itself. The next phase requires proof. Proof that personal AI agents create valuable behavior. Proof that advertisers will pay more because of automated tools. Proof that smart glasses can become a major platform. Proof that the infrastructure will remain useful long enough to recover its cost. Meta's advertising machine has given Zuckerberg the ability to make one of the largest corporate bets in history. But it has also created a simple test. If AI significantly improves Meta's products and opens new revenue streams, the $145 billion program may look like the foundation of the company's next decade. If not, investors may discover that Meta did not escape the logic of the metaverse era. It simply replaced virtual worlds with data centers.